Have you ever wondered what would happen if a bank, holding billions of dollars for millions of people, just vanished? In 2014, that's almost exactly what happened in the world of cryptocurrency. This is the story of Mt. Gox, the hack that shook the crypto world to its core and changed everything. Back in the early 2010s, if you wanted to buy Bitcoin, you probably went to one place, Mt. Gox. It wasn't some flashy Wall Street firm. It actually started as a website for trading Magic the Gathering cards. Magic, the Gathering online exchange. Mt. Gox. A French developer named Jed McCaleb turned it into a Bitcoin exchange in 2010, and it just exploded. By 2013, Mt. Gox was a giant. It was handling over 70% of all Bitcoin transactions worldwide. Think about that. 7 out of every 10 Bitcoins traded passed through their servers. It was the heart of the Bitcoin ecosystem. If you were into crypto back then, you had a Mt. Gox account. It was the only game in town. The price of Bitcoin was soaring, hitting over $1,000 for the first time. Everyone felt like they were on top of the world. But underneath the surface, the cracks were already starting to show. The first signs of trouble came in the form of delays. People would try to withdraw their money or their Bitcoin, and it would take days, then weeks. The excuses were always vague. Technical issues, regulatory hurdles, a surge in demand. The community started getting nervous. Forum posts on Reddit and Bitcoin Talk were filled with anxious users asking, "Where's my money?" But the exchange kept operating, and the prices kept climbing. So many people just hoped for the best. Then, on February 7th, 2014, it all came crashing down. Mt. Gox abruptly halted all Bitcoin withdrawals. The official reason was a technical glitch they called transaction malleability. Now, this is a real but complex bug in the Bitcoin protocol itself. In simple terms, it allows someone to change the ID of a transaction before it's confirmed on the blockchain, making it look like the transaction never happened. Mt. Gox claimed that because of this bug, hackers were repeatedly withdrawing coins, and the exchange couldn't tell if the withdrawals were legitimate or not. They said they needed to pause everything to fix it. The market panicked. The price of Bitcoin plummeted. People were furious, but many still held out hope that this was just a temporary technical problem. Maybe they'd get their Bitcoin back once the bug was fixed. But the silence from Mt. Gox was deafening. For weeks, there were no updates. The website went offline. The CEO, Mark Karpeles, went missing. The company's Twitter feed was wiped clean. It was like they had just vanished into thin air. Then, the bombshell dropped. A leaked internal document revealed the horrifying truth. Mt. Gox hadn't just lost a few coins to a bug. They had lost nearly 850,000 Bitcoins. At the time, that was worth around 450 million US dollars. Today, that would be worth tens of billions. 750,000 of those belonged to customers, and 100,000 belonged to the company itself. All of it was gone. The document revealed that the theft had been going on for years, starting as early as 2011. It wasn't one big hack. It was a slow, silent bleed. The transaction malleability issue was just a smokescreen, a convenient excuse to explain away a tiny fraction of the massive losses they had been hiding for years. The company was insolvent. The money wasn't just delayed. It was gone. On February 28, 2014, Mt. Gox filed for bankruptcy protection in Tokyo. The dream was over. Hundreds of thousands of people, from early adopters to everyday folks who had invested their life savings, lost everything. The fallout was catastrophic. It wasn't just about the money. It was about trust. Bitcoin was supposed to be a decentralized, secure system, free from the failures of traditional banks. But the biggest bank in the Bitcoin world had just imploded, taking everyone's money with it. The mainstream media had a field day. Headlines screamed, "Bitcoin is dead." Experts declared the entire experiment a failure. For many people, the name Mt. Gox became synonymous with crypto scam. It created a stain on the reputation of Bitcoin and the entire cryptocurrency space that would last for years. In the aftermath, the hunt for the missing Bitcoins began. A few weeks after the bankruptcy, Mt. Gox miraculously found 200,000 of the lost Bitcoins in an old, forgotten digital wallet. A small comfort, but over 650,000 bitcoins were still unaccounted for. The CEO, Mark Karpelès, was arrested in Japan, but not for the hack itself. He was charged with embezzlement and data manipulation, accused of moving customer funds for his own personal use. He was eventually acquitted of the major charges but found guilty of manipulating data. To this day, no one has been officially charged for the actual theft of the bitcoins. So what was the legacy of Mt. Gox? It was a brutal, painful lesson, but one the crypto world desperately needed. First, it highlighted the massive risk of centralized exchanges. The phrase, "not your keys, not your coins," became a mantra in the community. People learned the hard way that if you don't control the private keys to your crypto, you don't really own it. This disaster fueled the development of hardware wallets like Ledger and Trezor, and pushed people towards more secure, decentralized ways of storing their assets. Second, it forced the industry to grow up. After Mt. Gox, new exchanges like Coinbase and Kraken emerged, but they did so with a heavy focus on security and regulation. They implemented proof of reserves audits, multi-signature wallets, and cold storage solutions, storing the vast majority of funds offline, where hackers can't reach them. The Wild West days were over. To regain public trust, exchanges had to prove they were safe. Finally, it showed the resilience of Bitcoin itself. Despite the largest exchange collapsing, the media declaring it dead, and the price crashing over 80%, the Bitcoin network didn't flinch. It kept processing blocks every 10 minutes just as it was designed to. The protocol itself was never hacked. The failure was a human one, a failure of a centralized company. This distinction proved to be crucial. It demonstrated that while the companies built around Bitcoin could fail, the underlying technology was robust. The Mt. Gox saga is a dark chapter in crypto history, a cautionary tale of greed, incompetence, and the dangers of unchecked growth. But it was also a crucible. The fire of that collapse burned away the industry's naivety and forced it to build a stronger, more secure foundation. The crypto world we see today, with its focus on security, regulation, and self-custody, was forged in the ruins of Mt. Gox. It was the hack that almost killed Bitcoin, but ultimately, it made the entire ecosystem stronger. Thanks for watching. If you found this dive into crypto history interesting, please give this video a like and hit that subscribe button for more stories from the world of digital finance. Stay safe out there, and always remember, not your keys, not your coins. See you in the next one.